Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50 with Dallas and Michael. Today we're getting back into listener questions, Dallas. So that's good. We haven't done some of these for quite some time. So this question comes in from Colette. And Colette asks, Colette's comments are, she'd really like to know the benefits and downfalls of having death and TPD insurance cover within super, and if there's anything that we need to look out for. Also, how much coverage should most over 50s be looking for with these insurances?
That's right, Michael. So probably one of those things where you go, a good topic for a listener to bring up, because it's kind of a bit of a morbid and a bit of a boring topic, I guess, in some ways. Most people, like all insurances, most people know they probably need some sort of cover, or maybe they do, or maybe they don't. But it's not something they really want to think about, because the reality is it's not a pleasant thing to think about. So it's probably a good one to have someone to force a hand and make us go over this. And so, I guess there's a few different components to this. So I think to answer the coverage question, but how much coverage should most over 50s be looking for? This is going to be one of those really torturous, wishy-washy answers where we say it depends, but that's sort of the reality. One thing that I'll say there, before we even get started thinking about how much insurance cover that you need, the important thing to bear in mind is that if you have insurance cover through super, so if you have life and TPD insurance through there, in the event of you becoming passing away or becoming TPD, you would also get your superannuation balance. So the way that I think about it for people over 50s is that usually in the event of their death or total and permanent disablement, the biggest component of the lump sum payout they get would actually be their own superannuation. It's not necessarily the insurance. So that's the first thing I think that's a bit different for over 50s. Is if you think of it, when you're looking at this and going, okay, well, in the event of my death, I'd want the mortgage paid off. Well, if your mortgage is $400,000 and you've got $300,000 worth of super, you really only need another $100,000 worth of life cover. So that doesn't really answer the question, but it's just something to think about.
Look, it's a hard one to answer. And it's actually an impossible one for us to answer, because we can't give advice. Yeah, and this is general advice. Yeah. And it's not specific to you, but the way that I think of it is ideally, I think of it as covering the gap between where you are now and where you want to be at retirement. So, like a really, really simple analogy there would be, if I'm at $1.2 million of retirement savings now, and I want, and my plan is to be at $1.6 million when I retire. If I had sufficient insurance to bring me up to $1.6 million right now. So if something happened to me right now, I either died or was totally and permanent disabled, if I had $400,000 of insurance cover, then that would take me between where I am now. It would bridge the gap between where I'm at now and where I need to be, if that makes sense. So, and again, we could get into trouble for
saying that's
how much you. It doesn't stop there. It doesn't. I just want you to know it doesn't stop there, because there could be many other factors of what at play of what you need to be covered for. Yeah. It's a very, very that my explanation there was a very, very simple explanation. Yeah. I think simple helps, I guess, when you're talking about a podcast. Yeah. But I mean, the other factors are at play, of course, are the cost. The cost is can be quite a lot, especially if you're in that example, someone that's has $1.2 million on the way to $1.6 million. Yeah. they're likely to be around 60 years of age.
Yes. So,
at that point in time. So
$400,000 worth of life and TPD cover is going to be...
is quite a lot.
Yeah, it's going to be very expensive. And this is one of those things where you go, so for someone becoming a client of mine, this is something that we look at with people. Someone who's becoming a client, this is actually one of the areas that, and I think we've talked about this before, where there are some decisions that we as the advisor feel very strongly about, and that we go, no, this is how it has to be. For example, your investment strategy of your superannuation and how that money is invested and working for you, or how much you're saving towards retirement. Those are things that we feel really strongly about, and that you go, no, if you are telling me this is where you need to get to, you sort of need to toe the line in these areas. When it comes to when I'm looking at life and TPD cover for new clients, I start the conversation by saying, I don't actually care what you decide here. This is a purely personal decision, and what I mean by that is that, as you just touched on, Michael, anyone in their 50s, as you get older, generally your insurance cover will get far more expensive. And so when I say to people, I don't care, I mean it is purely a personal decision around, you are here, you need to end up here. Now, you can either roll the dice and have no insurance cover and go, okay, well, if something happens to me, I just have to make do with what I've got, and I have to make my life work, and have to be able to support my lifestyle with whatever I have at this point in time, or whatever my surviving spouse has. Or you can be fully insured for that. And it really does come back to a personal decision around how comfortable are you with that risk. And some people, and it is what you find, this is why I've worked out over time that I just go, I don't care. I put my hands up and say, look, I'm happy to help you work out the best way to get yourself covered for what you think you need. But some people, and you would have seen this, some people come in and they couldn't sleep at night if they didn't have, and I've got clients of this, that they actually couldn't sleep at night unless they had, $500,000 or $1 million more of life insurance than what their spouse would probably need. You know what I mean?
Yeah.
It's sort of really important to them to know that if something happened, their spouse would be taken care of, and they're sort of happy to pay more than they probably need to in insurance premiums every year to make that happen. And then there are others that just hate the concept of paying for insurance, and there's a lot of them that just say, I don't care. I think that I'll probably be fine, and I'll probably get through. And if something happens to me, then we can just work it out after that. We'll just change our lifestyle. We'll change whatever we need to. I just don't want to pay anything in insurance premiums.
Yeah, well, here I guess is the problem. And I'll give you an extreme example. So a client of mine who's recently become a client, he had no insurance through his superannuation fund when he came to see us. And I said, this super fund usually has insurance. He said, I had to cancel it. He said it was $15,000 a year was coming out in insurance premium. So so he's in his 60s now.
Yeah.
And if you look at that, the detrimental effect that has when you're trying to accumulate money in your superannuation fund is significant. Yeah. So he was of the opinion, hey, statistically, I'm still a low chance of dying each year because the mortality rates are still quite low for someone in their 60s. What was going to be assured if he continued to pay $15,000 in premiums, it was going to be virtually 100% chance that he wouldn't meet his retirement target goals.
Yep.
So, whereas he said, if I've cancelled my insurance, I don't have insurance cover. It's I'm still only a very, very low percentage chance of actually something happening to me and passing away, for example. So I could certainly understand that decision that he made. It was a decision that he'd made himself. Yeah. It's a hard one. It depends.
It's actually very different, I find, for, again, the whole podcast called Money Over 50, but when I think back to when we used to take on younger clients, that was kind of, to me, when we had younger clients, it was just a non-negotiable. If I was meeting with someone who was 30 and had 3 small kids and a $400,000 mortgage, I just said, look, you need at least $1 million worth of life insurance. I'm not even going to have a debate with you about it. It's because you really have that need. And your spouse's life would be really hard if something happened to you, and the cost of that cover was so cheap for that 30-year-old. It it made no sense not to have it. Whereas once you get into your 50s and 60s, that trade-off becomes much, much trickier to make. And it's really a personal decision around, I mean, it's like everything in life. It's a trade-off. If you had unlimited money, then it wouldn't matter. Have as much insurance as you want, because there's nothing else to sort of think about there. But as you say, when you're looking at 10 years out from retirement, if you compare no insurance premiums coming out, or $5,000 insurance premiums coming out of someone's super, or $15,000 insurance premiums coming out, they're vastly different retirement outcomes. And so that's kind of where, if you look at those as the extremes, you think, well, it's really not. It's kind of almost to some degree not my place to say then as to which of these trade-offs you should make. And that's kind of what we're generally looking at with people, is going, this is the cost, not just this is the cost for you for the year to have these insurances. This is the cost to you in 10 years' time. If you take out this cover and you hold it for 10 years, this is the impact that it will have on your retirement. And are you willing to trade that off, or do you want the certainty of protection, or do you want the certainty of a better outcome in retirement? And it's really a personal decision.
And what we see quite often, Dallas, is that most clients that are coming to see us, they sometimes unaware that they have insurance coverage through their superannuation fund, and if they are aware, ordinarily they haven't adjusted the amount usually. So typically, what will happen is someone will come to see us at in their early 50s, early to mid 50s, and we'll see their existing superannuation fund, and it'll have the base level of life and TPD insurance. It may have some income protection insurance attached to it as well. And they really haven't thought about it too much. It's just been an automatic thing that the fund has had. And by that stage, it's again typical. It's typical with insurance that the price increases as you get older. It's an odds thing. So the insurance company says, okay, you're a 50-year-old. Your chance of becoming totally and permanently disabled is X percentage. We'll charge you X percentage. At 51, it changes it. Yep. At 55, it changes it quite a bit. Yep. In fact, your odds go up exponentially. Yep. What most insurance companies do inside superannuation is they, instead of increasing the amount that you pay in premiums, they actually reduce. They do the opposite. They reduce the amount of cover that you have. Yep. So you might have $300,000 of cover as a 40-year-old. By the time you get to 52, that may have dropped to $100,000 because instead of increasing the premiums,
and that's actually
they reduce the amount. So that's typically how it works inside superannuation.
Yeah, I've actually had that conversation before with people where they've sort of got upset at their super fund, and they've reduced the amount of cover, and to some degree it makes sense, because generally what's happening is as you get older, your dependent children are getting off your hands, your home loan's coming down, your super balance is growing. So in the event of your death or TPD, you probably do need less cover. So that, what they call that unit-based cover, where you're paying a certain amount, and as you get older, the amount of dollars of cover you get comes down over time. It can actually it makes sense, I would say, in that way. Now, whether that amount of dollars of cover is right for you is a separate issue, but it is something that the useful part of that is that it's happening without sort of, it is going down over time without you having to make a decision. Whereas what you want to avoid, and I think that's what you were touching on before, is if you take out $1 million worth of life cover when you're 40 years old and you've got 3 kids at school and a mortgage and all the rest of it, and then you get to 55 and you've still got that $1 million worth of cover, the cost of that has gone up dramatically, and your need for that cover has probably gone down dramatically as well. So it's probably not as good of a trade at that point in time. And that's it is, I guess the point with all this is that where I say it's a good topic to bring up is because it is important. It's important to try and reduce those costs coming out of your super. Now, we can't decide, and even if we knew someone's personal situation, we can't make that decision for them. That's a personal decision, but it is an important thing to review.
It's an important
every
decision. I
couple
mean,
of
we
years.
do have the discussion about the trade-offs involved. So, Colette, I think we're answering the second part of your question. So, I mean, we go back to that. So, Colette says, how much coverage should over 50s be looking for with insurance policy? So, again, it's one that we can't specifically answer, but you can go through the scenarios with people, and you can say, okay, in that example, you have a couple that has $1.2 million in superannuation, combined superannuation. They're looking to get to $1.6 million. They could have $400,000 of cover. They could have half that amount. They could have no cover. Different scenarios there.
Different costs.
What I like to do firstly is look at the extreme. So the extreme would be, okay, if you had no insurance cover, one of you passed away, what you'd be left with is $1.2 million. You'd be left with half of your income. That because what you're losing, apart from losing your loved one, is you're losing that person's income producing capacity. Obviously they're not spending money, but it's not half the cost for one member of a couple to live. It's with fixed costs like housing costs and rates and all those types of things. It's just as expensive for one member of a couple to incur those costs as it is when there's two. But your costs do reduce a little bit. You don't have the discretional spending of one person. So in some of those situations, $1.2 million may be enough for that. You play that scenario out and you say, okay,
that's a good point, because that's the only way to do it is to actually sit down and again, it's very morbid and it's not a fun conversation, but it's to stress test that. Okay, you've got 1.2 million. Now, if you've got a couple, if one of you passed away, what would that look like? What would your lifestyle look like? Yes, is that sustainable? Is that feasible? Okay, great. In that case, you probably don't need the cover. If you go, no, that'll really put a dampener on things, well, maybe you do need the cover. And then you look at the cost of that, and then you look at the trade-off of is the juice worth the squeeze there? Is that cover worth the difference that would make to our lifestyle if the worst case happened?
Yeah, and at that stage of your life, you can review that every 12 months. Yeah. So you can say, okay, in this example, if the person or the member of the couple in this case decided to be fully insured, and they said, okay, we've got 1.2. We want 1.6. We're going to hold $400,000 of cover. In 12 months' time, assuming that 1.2 grows to 1.3 with the contributions that they've made and the natural growth, what they could conceivably do at that point in time, and what they probably should do, is reduce their cover from $400,000 down to $300,000. So they can reduce fairly quickly. Yeah,
and that's a good point, because you then, like we say, at that stage of your life, that cover is going to get a fair bit more expensive every year. So you really do want to be on top of that. You want to be pulling that down as much as possible.
The first part of Colette's question, so she'd like to know the benefits and downfalls of having death and TPD insurance within super.
Yeah.
So let's talk about that now. Assuming that you are going to have some insurance cover, death cover and TPD insurance cover, having it within super is theoretically cheaper than having it outside of super. So for every $1,000 of life insurance premium, let's just talk about life or death insurance first. And TPD is a bit more complicated.
Yeah.
But if I'm going to have, $100,000 of life insurance or death insurance, it's interchangeable, and it's going to cost me $1,000 of premium for that $100,000. If I put that into my super fund and it costs me the same $1,000, that's technically tax deductible to the super fund.
Yeah.
So the tax deductible rate is 15%. It's an expense to the superannuation fund if structured correctly. What that does is give you $150 tax rebate effectively off your premium, and your premium then becomes $850. So it's cheap. It's 15% cheaper if structured correctly within your superannuation. There's an anomaly there. Usually, if something's tax deductible,
the payout
is taxable. However, if the payout is going to what's known as a tax-dependent beneficiary, of which a spouse is. Yes. So a member of a couple, one person dies, leaves $100,000. The beneficiary of that is their spouse.
Yep.
That $100,000 is paid tax-free.
Yep.
In that situation. It's a tax-dependent beneficiary. So there's a bit of an anomaly there. Again, usually if you get a tax deduction on the premium, which you do, if it's structured correctly within superannuation, a 15% tax deduction, you can get the proceeds tax-free if paid to a tax-dependent beneficiary.
So
Now, children at that stage generally wouldn't be. They could be.
If they're non-dependent.
So if you're approaching your 60s, generally speaking, your children would be more than likely financially independent.
And if they're not, we've got another whole separate thing that we need to talk to you about, which isn't about insurance, which is about getting your kids off your hands, and that's probably more important for that reason than for your insurance cover.
Yeah. In many aspects at that point in time, it would generally only be members of couple that have the need for life insurance
to protect for each other.
If someone's single, in their approaching their 60s, and their children are independent of them, and financially independent, there would generally not be a great need for life insurance at that point in time because in the event of that person's passing, they don't have anyone relying upon them.
No.
Whereas it's different if you have a spouse. You have the spouse that relies upon you. So, generally speaking, under that assumption, if you're a member of a couple, you could structure your insurances, life insurance,
so that
via superannuation, and the premium, if done correctly, would be 15% tax deductible.
Yep.
And the insurance proceeds would be tax-free if paid to a dependent beneficiary, of which your spouse is one.
So that's the main sort of benefit, really, I would say. To me, the main benefit of having cover through superannuation rather than paying it out of your own pocket is that tax advantage.
Yes. Yeah. And again, people often ask me, they say, okay, I can't see the tax deduction coming out of my insurance on the super fund. Well, the super fund is doing that in bulk if you haven't actually applied for that cover. And they're actually applying the tax deduction in the premium discount.
Yeah.
TPD insurance. Cannot answer that question. Sorry, Colin. It's just we couldn't. There's a different formula here. If you are approaching your 60s, it's not a big problem. So technically, if you get paid a TPD benefit,
it's in lieu of the income that you would have earned over the rest of your working life, basically. And so because of that, the tax treatment is different to a death benefit.
The tax treatment's different. Look, once you're over 60, it doesn't matter. You can convert whatever funds. So let me back up. You have $100,000 of total and permanent disablement insurance. You're made, and it's through your superannuation fund. Again, that is a 15% tax deduction on the premium. So a $1,000 premium would come down to $850. You're made totally and permanently disabled, and if that happens at age 50, and you want to take that $100,000 is paid into your superannuation fund, you then have access to your superannuation fund. However, if you pull that money out at that point in time, you would pay some tax. We sort of couldn't go into the formula.
No,
it's just too.
Even my eyes would glaze over if we went into the formula. It's true.
I mean, every time I see that happen, I actually have to get out the formula again and go through it step by step. It's convoluted. If that happened to you at age 60, and you took money out after age 60, you got the $100,000 of TPD insurance paid into your super fund. Let's assume you had $1 million in your super fund already. $100,000 goes in, you've now got $1.1 million. You can theoretically cash that out completely tax free or draw tax free income from it. After age 60. So So
I guess the benefits and the downfalls of owning that cover through super, separate to the cash flow sort of funding issue, is that it's generally just easier to have that come out of super for people, and they don't have to worry about that. But most of the benefits and the downfalls, I would say, are tax related. So for life cover, it's just a benefit, basically. There's no real downside to owning that life cover through super, because if you've got life cover at that age, normally it is for your spouse that it's predominantly the benefit for. TPD cover is a bit more convoluted, but I would still say that it's in most cases beneficial to have that TPD cover through super rather than in your own name, because you do pick up that it's deductible to the fund. It's slightly cheaper. As you said, there is a tax treatment on that money if you're TPD, but it's generally not a huge issue at that.
And we are called money over 50, yes. So we're assuming that you're over 50 years of age.
Yeah,
and look, usually there's a way around that as well.
Yeah.
So basically, if you get made totally and permanently disabled at age 55, you've theoretically got 5 years to go before you can get money tax free. However, for most people, what they're doing at that point in time is opening up a superannuation income stream.
Yep.
Because they've met their conditional release by the total and permanent disablement.
Yep.
They draw an income from that, and we can be strategic about how much you take, so that it's not 60. You inevitably don't pay any tax.
Yep.
You're within your rights.
Yes.
Also, to take an income and to push some money back into superannuation.
Yeah.
And claim that as a tax deduction as well.
Yeah.
So there's different ways to. You love to hurt animals. There's different ways to skin that cat.
Just to clarify, you should explain to people that I don't actually like to hurt animals.
I always talk about skinning cats and dead cats bouncing and all that.
You're the one who always talks about dead cat bounce. I like the concept, but it's
we love animals here. So you've got a little designer fluffy dog that you carry around.
Larry, I've got to get home very soon. He's at home alone, so I've got to go and take him for a walk. So, but I think so. The other point, just to touch on, as you said before, it is money over 50. Something I was just thinking about, the difference between looking at your life and TPD insurance when you're in your 50s versus 30. Most people, when they're 30, a couple that are looking at cover when they're 30, you normally they probably both need around the same amount of cover. Like if you've got a husband and wife and one of them is staying home with the kids and one of them's working, even though one of them might not be earning an income, you still need a fair whack of cover for both of them, because if something happens, the working spouse would then have to cut back on work probably to take care of the kids. Now, what's a bit different, I think, when you're in your 50s is that when you're running those scenarios, the amounts of cover that you need will probably be different for each spouse, if that makes sense. So like you were touching on before there, if you've got $1.2 million worth of cover and your retirement target is 1.6, you might look at that and go, okay, well, we need more cover for the higher income earner because it's going to be their income that gets us from 1.2 to 1.6 million. And so you sort of want to look at that on a case-by-case basis for either of you. So there's really sort of 4 scenarios you'd run, which is that if you've got a couple, member number 1, if they passed away or became TPD, what are the 2 scenarios that we'd look at there? And for spouse number 2, what are the 2 scenarios if they passed away, became TPD? It's not one size fits all across the board. Even though I do find that's always funny because couples go, it tends to end up converging on the same thing, because one of them goes, well, we probably need 300,000 for me, and they go, well, if you get 300,000 if I die, I want 300,000 if you die. So, but that is just something else to think about, is that it does tend to be more so in your 50s and 60s. You can have very different amounts of cover for each member of the couple.
Yeah, absolutely.
Anything else to add before we wrap that up?
No. So, Colette, hopefully that answered your question. It's something we haven't touched on before, and it's probably of interest to some people that are listening, because it's a common thing to see your superannuation fund have insurance, and it's one of those things to it's definitely something that needs to be discussed and decided on. It's part of the plan.
Yeah, it's. I actually think it's probably a good forcing mechanism, Colette, for giving us this thank you, because it's not the most exciting bit of retirement planning, if we're being honest. When we talk about drawing money out to go and travel, or semi-retiring, or doing all these exciting things, it's. I think about this insurance as it's really a hygiene issue. You need to get it right. It is important to make sure that you know what cover you've got and that you're not paying for more than what you need and all those sorts of things. It's not the most exciting thing. So if you've powered your way through this podcast with us, well done for sticking to it. And if you go and have a look at what you've got, have a look at what you need. It is important to get it right, even if it's not the most exciting thing in the world.
Yeah. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. We look forward to catching up again soon.